All right, hello everyone, good morning. Thank you for joining us. This is the webinar, Post-COVID is Changing Investing, Are You Ready? We are glad you joined us. We have a very exciting lineup of exceptional speakers today, so I think you'll all leave getting a lot of good information out of this. Before we begin and before I hand it over to our panelists, I wanted to just go through a couple of kind of helpful guidelines to give you the best experience possible during the webinar. First and foremost, I want you to know that we will not be able to see nor will we be able to hear you during the webinar, so don't worry about combing your hair or getting out of your pajamas because that stuff's off limits to us, we can't see it. However, you will be able to, and I'm very encouraged to, ask questions throughout the webinar. And I wanted to just show you quickly on the screen, hopefully everyone can see it. We are at the bottom of your screen, you will see a Q&A button. Kind of if you hover over the bottom of your monitor, you'll see Q&A. So once you click that, you'll have a screen that pops up that allows you to ask questions. We'll be reserving the questions. I'll have them on the side, and we'll have the last 10 to 15 minutes of the webinar dedicated to just questions and answers. So hopefully we'll be able to get to most, if not all, of your questions. I know a lot of people are very interested to learn as much as possible today. The second thing to know is when you do ask a question, it can be done anonymously, and it's just as simple as clicking the send anonymously little checkbox at the bottom of the Q&A screen. That way, if you don't want to share your name, it's completely fine. You can send your question anonymously. So I think that was all sort of the housekeeping things I said. One more thing is just you're going to send out just sporadically throughout the webinar just to keep it interesting, a few polls. So if you have a second, just click a couple of answers on the polls. Again, the polls are completely anonymous, so don't feel like you have your name attached to anything, any information that you're submitting to us. So hopefully we'll have fun today. And let's get started with our panelists. So first, and let me get him started here, I'd like to introduce to you, start video with Leo Kelly. There he is. Hi, Leo, good morning. And I can unmute Leo as well. Can you hear me now, Leo?
I can hear you. Is that fine?
Fantastic, thank you. All right, so I have the honor of introducing our CEO. Leo is CEO of Verdence Capital Advisors. We have two offices. We're a $2 billion investment advisory firm. Leo himself is the founder, CEO, and partner of Verdence Capital Advisors. Leo's expertise is really in advising high and ultra high net worth business owners, entrepreneurs, executives, professional athletes on just complex array of financial topics. He's our firm's spokesperson. He is a regular contributor on Fox Business, CNBC, Bloomberg Radio, Bloomberg TV, often asked as an expert for his opinion for the Wall Street Journal and countless others. So we're very happy to have him here today. He and his family reside in Moncton, Maryland. And Leo, I understand that you celebrated a big milestone last week with your twin girls.
That's right. That's right. I have twin daughters who graduated college, one from the college in Jersey and one from Villanova. And we experienced a virtual college graduation, which is a little less pomp and circumstance, but definitely comfortable in the living room watching the heads of the schools go through the process.
Congratulations. I'm going to go ahead and start some videos with our other panelists, but Leo, I will hand it over to you so you can introduce the panelists and then we can get everything started. So thanks everyone.
Sounds great. Thanks Michelle, and welcome everybody. We're happy to have everybody on the call today. We are looking forward to a great conversation about the changing world that we live in with coronavirus. I'm going to introduce the two other panelists today who we look forward to getting some great insights from. First is Mike Hoffman. Mike has been with Verdence Capital Advisors for over 10 years, coming from T. Rowe Price. Mike is the Director of Financial Planning for Verdence Capital Advisors, and Mike's job is to integrate with the advisors here in the firm to provide advice to our high net worth and ultra high net worth clients around some of the more complex financial planning issues that really pop up in these times. So Mike, thanks for being on the call. Welcome.
Glad to be here. Thank you.
And I am also delighted to introduce Mike Gill. Um, there he is. Good morning, Mike.
Hello, Leo.
So,
Great to be here.
Mike has a star-studded past. He started in 1974 at IBM as a rookie sales rep, and some 40 years later, was the first Secretary of Commerce for Governor Larry Hogan here in Maryland, and without question was one of the most inspirational and positive economic leaders that we have seen, and really did a wonderful job of driving the business efforts here in Maryland. And I'm going to let Mike talk about that. In between, he did a couple other things. In 1984, Mike founded Americon, a technical services company in the wireless industry, and had a lot of success with that. By 2000, he had grown the business significantly, and then moved on. In 2007, Mike joined Evergreen Advisors, where he currently stands as chairman. Evergreen Advisors works with businesses in the area, helping them through complex issues. Mike is an outstanding voice of leadership in that organization, which we have worked with and been friends with now for some time. So welcome, Mike. Glad you could be on the call.
Thank you, Leo. Thank you.
So let's dig in. So the theme is, we're the post-COVID world, change, investing. And in our pre-call conversation, I think the word you used was pivot, Mike. And I'd love to hear you talk about that and talk about your famous culture of yes.
Great. Thank you, Leo. And thank you for having me as part of this. And I did want to assure the viewers that I am not here to give investment advice. That's for everyone else. But let me do share with you some things that are always on my mind, and it's certainly an appropriate time. I think maybe just to take a minute, Leo, and just to quickly, I'll roll through 4 years in the commerce job in just a few minutes. I can do it in a few minutes, and to just give a little summary of things. Little fun story. So I went back to Evergreen a little bit over a year ago, and the governor got reelected, and I met with him in his office soon after, and he said, "Hey, Mike, you think you got 4 more years in you?" I said, "Gov, I've had a blast. Thank you for the opportunity. I can't imagine not having done this." And I said, "But I'm going back to the private sector." And he said to me, "Take me with you." So I'm glad he stayed right where he did. Michelle, would you put up that slide with the pirate? If you, let's see. Yeah, very, very quickly. I never had a government job in my life. The governor and I compared notes. We didn't even get elected to student council in high school. But I came across a theme early on about pirates. So we became pirates at Commerce. I had a great assistant secretary, Ben Wu. Early one morning, he was texting me. He said, "Hey, Mike, Steve Jobs has a great quote. And his quote is, 'It's more fun to be a pirate than join the Navy.'" So we took right out of the gate a very business-like approach to everything. And as Leo said, we called it a culture of yes. Because my whole life has been one of, if you just take the right approach to things, and in Maryland, the businesses in Maryland, I mean, the thing that I think that I heard often is the businesses would say, "We just don't want government to hurt us. If you could be our ally, that would be fabulous. But we would just like you to just not try to stand in our way of being able to do things." I would talk to groups of people. I probably, a number of the folks that are listening to this, I know you, I've had a chance to be with you. But I would talk about the fact that at the end of the day, it's the positive attitude that makes the difference. I couldn't do anything about taxes in the state of Maryland. The tax structure is a structure. Regulatory environment, the governor has done his best to chop away at some of the regulations, but I knew where we could make a difference was regarding attitude. And as I traveled around the state, all 24 jurisdictions, You know, I used to laugh that there were 6 million people in Maryland, and I came pretty close to probably meeting every single one of them. But the one thing that I said often was, I would say to a business, how can we help you? That was our number one thing. How can we help you? Michelle, if you would just flip over to the big six, I want to just make a couple comments. I'm going to come back to Leo's comment regarding pivot. Gang, first of all, I know that the folks on this call, we're all over the map relative to your businesses, relative to your individual situation. 33 million people who are jobless today, and we hope that a percentage at a time that starts to come back over the next 30, 60, 90 days. But in 1989, I discovered the Big Six. It's a Jack Welch special. I borrowed it. I had no reason to believe that he was the creator of it, so I borrowed it with pride. And if you look at the first of the Big Six, face reality as it is, not as it was, or you wish it were. 90 days ago, we didn't see this coming. And all of a sudden, bam, here it is. So when I look at face reality as it is, not as it was, you wish it were, it really says the reality is COVID-19 has disrupted our lives significantly. And we have a couple choices. I learned a long time ago, if we took the choice of negativity, the likelihood of us being able to deal with it as well as we could have is slim and none. But the concept of pivot, you know, we've all been using the Gretzky factor, probably too much, but it's appropriate right now. And when I say that, it's skating to where we think the puck might be. Every single business, whether it's healthcare, real estate, construction, financial services, they're all in play to be changed in a significant way. And I think what everyone needs to be focused on now is thinking about not where we've been, because we're not going back to where we were. And there will be some huge wins out of this COVID-19 for businesses that figure out how to pivot and really rethink everything that they ever did. So with that, I just really thank you, Leo, for having me be part of this. I am long-term bullish, and I think you might have something to say about that. But thank you for the opportunity. By the way, one other thing on the Big Six I would point out to you, the last one, control your own destiny or someone else will. There's no one that's gonna tell you how to spin out of this. It's your call. You control your destiny. Make the most out of it. So if I could, let me hand it back to Leo. And again, thank you for letting me be part of this.
Mike, great words. Thank you very much. And we're going to come back to you here as well. Let's, you know, I think at this point, to Mike's point, let's dig in a little bit to what we're seeing from our viewpoint and try to blend the business issues that Mike brings up. We have a different world. People are facing a challenge that's somewhat unprecedented, obviously. But what we've found throughout this process is that the world seemed to, very early on in this process, seem to bifurcate. And I've been stunned at that nature, that binary nature of decision making that has been happening. In other words, we shut everything down and save everyone, or we open everything up and put everybody at risk. And obviously what we need at this point is leadership. Things are going to change. And today we've been talking about this through the whole process. And the term I've used all along is rate of change. The rate of change is what we should all be looking at. And that's why it's so important, the topic of this conversation. What is the rate of change in the economy? What is the rate of change in the science? What is the rate of change in the political mood? Those seem to be the big three, and those are what impacts markets. Those are what impacts the recovery of the economy. Now, I will say, by the way, and I'm not going to get into a political discussion. I'm not going to get into a right versus left, who's right, who's wrong. But here's what I would say. Traditionally, we have said that politics don't really have a direct impact on markets. They are really more long-run issues for the markets. The markets are looking at earnings in the economy. But right now we're at an extraordinary moment where obviously there's a small group of people that are controlling a vast amount of the economy. And so we have to bring those in. So let's dig in a little bit to where we are and what we're seeing and where the rate of change is right now, where we are currently. I thought I would start though by giving us some perspective. So let me show you what we all fear. So Michelle, if you could put up the what we fear chart. So what we fear is this. This is a significant downturn in the market. And if you are looking at the numbers, you'll see that we top out in this particular case, this example of 340, and we end up down around 220. That's a massive decline, massive decline. But most importantly, you can see that there's this one moment of a massive pullback in the marketplace. And I asked the question, does this look familiar? And the answer is it should. When we just went through here in March, where we bottomed out in the third week of March, we saw spectacular moves in the market, 10+% moves in a single day. And so this is what we all fear. We fear this, having our money in and having a stunning drop and losing our value, and then this kind of grinding along over time and not really recovering. So I'm sure everyone has heard it's going to be a V shape or a U shape or a W or the old L. And what does all that mean? Well, V shape is as described. It goes down and it bounces back very quickly, and we go back, whether we're talking about GDP, the economy, or the market itself. A U shape says we go down and we kind of we linger around at the bottom for a little while before we recover, and that's obviously a lot more pain for people as they go through that process. And then you can imagine what the others are, W. Now the L is it goes down and it never comes back. And here's what I will tell everybody on the call, every bear market I've ever been in, some expert has said it's an L shape. But I think what all of those circumstances, the bias there is to the short-term thinker. The bias there is to human emotion. And let me explain that. Human beings in their nature want to end the pain when they feel pain. And so when markets are under extreme stress, human beings want to eliminate the pain. How do you do that? You sell. But that's a short-term thinker. The reality is that we crave tangible evidence. We crave evidence that we can hold on to and have certainty around. That, again, is a human condition. And that's what makes investing so hard. Because when things are up, you want more and more and more of it, because tangibly it says things are great, keep going. And when you have a crash like the one you see on your screen here, the pain is so hard and it's so tough to deal with that our human condition says, just go, just get out, end the pain. Look where you are and backwards. But what we have to do is we have to look forward. And so it's kind of like if you drive your car, and there's a lesson in race car driving, where if you drive your car around turns and all you do is look at the road just beyond your hood, you're constantly making adjustments as you go around the turn. But if you lift your head and you look out to the apex of the turn, you automatically make that turn. And that's harder to do. That takes a certain level of confidence. So as we look at investing today and the change, we're going to look at some of the changes, but I also want to bring back this one constant, and that is we have to be strong in our resolve when we're long-term investors. So here's what I will show you. This chart is actually 1987, and that crash that you see on this chart is 25% in one day. That's one day. Unprecedented. Almost unprecedented until now, but still unprecedented. Let's flip to the next chart. That circle to the far left is what we just looked at. That's the 1987 crash in the context of time. And as you can see, the U shape that we saw on the short-term chart suddenly looks like a V. Suddenly it looks like we came down and then we had a nice steady climb. In fact, just some data. we were at around 200, and obviously today the S&P 500 is trading at almost 3,000, a massive increase that a long-term investor enjoyed during that moment. But I'm going to give you some specific statistics, which I think you'll find interesting. If you were the most unlucky investor in history and actually invested the day before the 1987 crash, the day before the biggest one-day drop in history, your rate of return from the day before the crash till today, over 40 years, would have averaged 9.8%. That, by the way, is in line with the historical market. Now, if the market had crashed and you had added to positions or you invested after the crash, which is always the hardest thing for human beings to do. When the crash hits, you're afraid, you want out, and you don't want to invest. But if you had actually invested after the crash, you would have made a rate of return of about 10.5%. Doesn't sound like a lot, but compounded over 40 years, it's an enormous number. Now, when I've used this example in the past, I've had some people say to me, yeah, but Leo, that's 40 years. I don't want to wait 40 years. So let's look at a market cycle, which we define as 10 years. If you would have invested the day before the 1987 crash and saw the single worst one-day drop in history for an investor, your return 10 years later, if you just stuck it out, would have been 16.3%, 16% the day before, 18 if you did it the day after. So yes, our advice here is not to invest the day before a market crash, but our advice is to maintain a long-term perspective. If we're going to invest in equity, we will get higher rate of returns as long as we maintain that long-term perspective. And we don't take the short-term thinking on, because that's where you can do damage. As we always say, there is risk and then there's volatility. Volatility is just the movement of money up and down and up and down. The stock goes from 20 to 10 and then ends up at 40, you still make money. It's just volatility. But if the stock goes from 20 to 10 and you sell, then obviously you've lost money. That's risk, the loss of money. So with that history and context, let's look at what's happening today so we can start to think about how do we manage investing today. Let's go to the next slide. Obviously, we have seen this massive shutdown, this forced disaster in the economy that is nothing short of remarkable. However you feel about should we reopen or should we stay closed, what we do know is we should protect the vulnerable. And what we also know is we're in an unsustainable situation. We have to reopen. How may be debated, but if is not debatable. And what this first chart shows is going back to April 1st. Now the market bottomed in March and on the 23rd. And that's, I would tell you, when there was the least amount of hope, when we didn't know if there would be a vaccine, when we didn't know how long the shutdown would take. We heard that the market or the economy could be shut down for 6 months, 12 months. We just didn't know. There wasn't enough information and data. Further, the models were showing deaths in the millions here in this country. Well, the models proved to be widely inaccurate. And just yesterday, Moderna announced an astonishingly successful first stage test on a vaccine. So fast forward to May 15th, and as you can see on the second chart, we're starting to open. We still have several states in a lockdown. We are partially reopened in a great part of the country and fully reopened in a couple others. So we are starting to see some evidence, not just that states are opening, but we're actually seeing other forms of evidence. Let's take a look at the next slide, that people are starting to come out of the deep freeze. This is Georgia, and I bring up Georgia not to poke a political bear, but to say this is probably the most controversial moment during the reopening or don't reopen process when Georgia said, we're going to reopen. And as you can see on this chart, the line shows when Georgia was reopening, when they begun the reopening. And the chart shows their confirmed cases, the 7-day average. So as we can see, cases continue to move down over the 7-point average. The dotted line is the preliminary estimate of where cases are going to go. And so what we see is that they're continuing to be estimated to fall. Now we'll know more in the next week or so, but this is good news. This says that the virus is not spiking on a reopening. And I think if we take a step back and we think what has changed, the theme of the call What's changed? What's changed is people's knowledge. Back in March, we had people saying, come out, it doesn't matter, we're fine, keep going to restaurants. People weren't social distancing, they were shaking hands, no masks. This is different now. When we see the reopening, people are being respectful. Now, not everybody's going to be, but what we know is that people understand what they're dealing with now. And so we are not going to see the same measure of increase that we did before. And here's why. We believe in adaptation, entrepreneurialism, and innovation of Americans. We have always been able to overcome situations like this because we take it on and we make those adaptations and we find a way, and we're doing it. We're doing it right now. The next chart will show you some of the new activity. That's just some early signs of what we're seeing. Next chart, please, Michelle. This is air travel. So this is TSA checkpoints. And as we can see, we bottomed out in early April, and this chart is starting to rise. We looked at some other numbers, including flights, and we're starting to see a tick. We were bottoming out here. You can see TSA down around 90,000. Now we're up to a couple 100,000. Not the 2 million we saw last year. We've got a long way to go. The economy's not fixed. The next chart, but again, the good news is change. We're starting to, rate of change in the economy is starting to pick up. This is weekly gas demand. And so here we are again, a bottom. We are still down from last year, but increasing. Rate of change is starting to pick up from a negative to a positive. Next chart. This is Google searches for VRBO. Okay, so the early stage of a recovery of vacationing or going out begins with searching on where you want to go. And so here we can see that collapsed in the beginning of the year, and it is coming back somewhat quickly. People are starting to think about it. I just saw the CEO of Starwood Capital on today, and they opened up a couple hotels around beach areas, and the hotels were 60% full. People want to be out. That was one of the big questions. Will people go out? Next slide. This is consumer confidence. Again, a disaster, rate of change negative, going down. Here's the turn. Next slide. We already kind of went through this. Let's go to the next slide, Michelle. And this is also important. So one of the big worries in the marketplace, both in investing and the economy, is that companies will go out of business, that there will be insolvency across the landscape. What you see here, very complex slide, but let me just show you very quickly. These are what's called spreads. So what's the difference between a rate of return on a bond and a treasury? So the first one, investment grade, year end 2019, 101. What does that mean? It means investment grade bonds were 1% higher than a treasury. Go down to high yield X energy, 295. That means they were about 3% over treasury. So let's focus just on two columns broadly. We won't go through all this, but 52-week high. So you see the spreads went up a lot. High yield, 1,100. That means 11% over treasury. High yield energy, 2,300. Global high yield. What all these numbers represent, look at municipal bonds, 650. What all these represent is that the market was concerned that the economy was going to fall apart and there'd be massive defaults. Now let's go to the end column. This is where we are today. Investment grade, 381 to 201. High yield X energy, 973 to 649. Now these are still higher than the beginning of the year, but the rate of change is positive. So as I conclude my section of this, I just want to wrap up with a couple thoughts. Rate of change on the economy is just at its earliest stages of showing some recovery and promise. We've got a long way to go. Rate of change on the science is moving very, very quickly. Moderna's news yesterday was obviously welcome, witnessed by a 900-point move in the market. We're seeing drugs, and by the way, Moderna's is one of 11 in testing and one of 100 currently being worked on. We're seeing enormous moves in therapeutic drugs, and we have said this from the very beginning. when every mind in science is on the tip of the same spear and it's being funded by massive quantities of money, when human beings collaborate in that kind of spectacular way to solve one problem, there is a extraordinarily high likelihood that problem will get solved. And that rate of change in science is moving remarkably fast in our favor, thank God. Thank God. Rate of change in science also has to do with knowledge and testing. So as we look at how fast technology is changing for contract tracing, for testing, but more importantly, just for us knowing, let's not shake hands. Let's not stand real close to each other in a crowded space. If we're sick, let's stay home. All of that is rate of change on science, which is positive. Now, as far as the politics is concerned, that will play itself out. Our hope is that as the data and the evidence continues to show progress, that we open up these economies and we have that economic rebound by the end of the year. But remember, the market is a forward forecaster. So my last thought here is, yes, there are going to be winners and losers, as Mike said, and we are looking at those every day. But they may not be who you think. Remember, the obvious is Amazon and Zoom are great winners in this economy, but those have already moved. When you look at the ones that have been hurt the most, who may recover? Will airlines recover? Will hotels recover? Will banks recover? These are all calculated risk versus return bets that we have to make as investors. And all of this rate of change data is going to inform that decision. And so in conclusion, we have to know what's changing, how fast it's changing, but most importantly, not change the core of what we do and what we always do. And that's be disciplined and not follow that human instinct to buy when everything's super high and sell when everything's very, very low. This is improving rapidly. The market is identifying that. And yes, the market is maybe not in line with what's happening every day in businesses or what you may feel. But let's remember, the S&P 500 is not the United States. The S&P 500 right now, 5 stocks or 20% of the S&P 500. That's what the S&P 500 is. But that doesn't mean there's still not opportunity. The broad market has not caught up as fast. There's still investment opportunity there, both in the public and private markets, where we see really some spectacular opportunities. So we're going to keep doing the valuation work, keep staying positive, but we're going to be realistic because a lot has changed. But most importantly, we are going to continue what we always do. Stay long-term focused and not try to trade this thing. It's too binary. It's too difficult. So with that, and I hope that's helpful, I want to turn the next section over because opportunities and investing opportunities are not just for the stock market. It's not just for maybe buying an ice cream stand around the corner that's been shut down, but it's also in your financial plan. And there are unique opportunities when markets are this heavily discounted and interest rates are this low. And we asked Mike just to come on and talk about a couple of those opportunities, some tangible takeaways for you in terms of financial planning opportunities. So Mike, can you dig in for us?
Yeah, so, I think I'm right on, on par with both.
Mike, you are muted.
See? Well, Michelle, can you unmute me?
We are having technical difficulties with Mike.
I can hear you, Mike.
Oh. Can you hear me now?
I sure can.
All right. So, I'm right on par with Mike Gill and Leo about the long-term nature.
Yeah, can't hear you, Mike.
Yes. So,
Okay, my fault. Go ahead.
What we have to be focused on here is the long term, right? So with that, planning is obviously looking long term. Like today, things don't look that great. When we look at a snapshot right now, obviously we're going through a lot. But what we can focus on is we know how markets react over long periods of time. And what we can do is take steps today when the market is depressed and, account values are down to take some strategies to either do some charitable things, to do some things to benefit your long-term net worth, or even to do some estate planning techniques. So for example, Michelle, if you can throw up that first slide, just kind of about financial planning. So one of the easiest things right off the bat is to say, okay, what about right now asset values are down, right? So a great strategy when the asset values are down in a market like this that's so volatile is to take a look at something like a Roth conversion, right? So where you take IRA assets and you convert them over into a Roth IRA today when the values are lower, you have to pay the tax on that. So you want the value to be lower because the taxes are going to be less the lower the value of the account. And then you look at a longer horizon. So if you still have 10, 20, 30 years before you need to use that money, right, then you're going to get all that tax deferred growth. And on the backside of it with a Roth IRA, you're going to be able to take that out tax-free versus having to take it out all taxable after it grows 10 or 20, 30 years from now. You know, and it's important to focus on the long term, but there's also some things we can do right now, right? So more than ever, there's probably more groups and charitable organizations that could use some money. And one great strategy, instead of just cutting a check directly to a charity, would be set up something like a charitable lead trust, right? So where you set up a trust and you put in a lump sum of money today, and that charity will then over a time period that you set will get an annual payment from that trust. And because the interest rates are so low right now, and the IRS sets these AFR rates, they call them, and they're basically these baseline rates, and they're really low right now. I mean, we're 75% down from where we were in February with those rates. The 3 to 9 year rate is at 43 basis points right now, which is historically low. So you can get a higher tax deduction than you could have if you just had done this in February, right? So things have changed in just a short period of time. So the other benefit of this is, so if you put the money in there and you give an annual payment to the charity, you know, after that set time period, you can pass those assets, whatever's left in the account with the growth of the account, would go to your heirs tax-free, right? So anything over that charitable amount that you're giving away, any growth over that, you'll be able to actually give away to your heirs tax-free and outside of your estate. And then there's one more I was going to talk to everybody about today. It's called the Intentionally Defective Grantor Trust. So if Michelle, if you could switch it to the next slide. It's a funny name, intentionally defective. You know, it's defective for tax purposes. That's why it's called that. It's actually a very effective tool in getting assets outside of your estate. And this is probably a great time to use it for two reasons. One reason being that the AFR rates, again, are low, like we just discussed. And then two, there might be some depressed valuations. So let's say you either hold a concentration of company stock, right? And you want to get that outside of your estate because you think the company's depressed just, this is short term. It's just because of COVID, and 20 years from now, this stock is going to be worth plenty more. Well, you could do an installment sale to the intentionally defective grantor trusts. That installment sale would then pay you, an interest and principal payment through it, and then your heirs would actually have all that growth in that trust for them outside of your estate. And again, because the AFR rates are low, that interest payment that you have to make is very low, and it doesn't put as much pressure on the assets to produce income today as much so as it would if the rates were where we were again just in February, 75% higher than where we are today. So there's a number of different things you can do. What we have to focus on, with planning is, look, this is a great opportunity to take a step back. We all just went through a very turbulent time. Take a step back, look at the long-term plan. You may find that while it hurts looking at the accounts today, if you look at the long-term, your goals may not have changed. They may still be funded. Everything may be okay. You may still be on track, right? And if you're not, we can make small adjustments to get you back on track. And then additionally, now's a good time to look at your risk tolerance. You went into this market with one risk tolerance. Maybe think about it. How did you react to it? How did it feel? Were you okay with the way everything fluctuated? And maybe look forward and say, maybe my risk tolerance is a little different than before COVID. So number of different things, but I think kind of like Mike Gill and Leo were focusing on, this very long term for planning. And we really have to take a look at this and say, you know what, this is going to create more opportunities in the planning space. It doesn't feel great today, but it is going to create opportunities for you long term. And I think probably going to pass it back to Mike Gill. I think Michelle wanted to finish off with him.
Yep, here we go.
Well, thanks, Mike. Let me just step in real quick. I want to thanks Mike for the tips. Just a quick comment before we turn it back over to Mike Gill. You know, Mike's points here are really, really pointed to this moment. And when you think about a Roth IRA, which is tax-free money, right? All the growth tax-free, and the ability to pass that on generationally, decades of tax-free compounding is extraordinary. And to get a massive discount on that tax bill today, and with the potential to grow that at above average rate is outstanding. And if you're thinking about your heirs, if you have done well for yourself in your life and you have the assets to meet your lifestyle, and you could start to think about how you pass on to the heirs, whether you have a private business or public assets or liquidity, it's time to talk to the advisor, because these moments in time happen once a decade and often once a generation. And they're really a moment to take advantage of. So Mike, thanks for those couple ideas. And if anybody has any questions on how to do those, we're happy to speak with you. So, so we've talked about the markets a little bit. We've talked about some different investment ideas. Mike, I want to turn it back to you, get some thoughts around what we just discussed. And maybe you can give us the closing way to think about how we handle this situation.
Leo, Michael, Michelle, you guys are awesome. Thank you for letting me be part of this. And I do have a little closing thought. And then Michelle, I know we've got some Q&A, so my closing thought is going to be quick so we can get to some of those questions. Michelle, can you pop up that slide for me? Oh, there we go. Yep, those are the 8 Gill grandchildren. And here's the story. May 4th, go find your old Wall Street Journal, May 4th. There was a great article called A Surprising Way to Stay Resilient. And the theme of the whole article was about gratitude. It was a great article. So go find it, May 4th. There was a little story inside of the article. Some of you may have read it and you remember it. Irving Berlin, arguably the greatest American composer, wrote White Christmas, wrote God Bless America. He suffered his entire adult life from insomnia, terrible insomnia, brought on by a lot of stress. So he went to see his doctor one day, and his doctor said, Irving, next time you wake up and have an episode, why don't you count your blessings? And he wrote a song that in 1955 was nominated for an Academy Award as Best Song, called Count Your Blessings. So go find that song. A lot of you can hear it in your head, Bing Crosby singing it. So it's pretty easy for me. These 8 little kids, they live within a half a mile of where Mary and I do. The husky one in the front is going to go to Loyola Middle. The tall girl is going to be a 9th grader at NDP. I'm holding out that tall kid on the right. I'm holding him out for Calvert Hall. I got to get a Calvert Hall kid out of this bunch. But the parent of a couple of the boys is a Loyola parent, so I have little chance there. So again, thank you. Count your blessings. We all have many of them. Michelle, let me kick it back to you.
All right, thank you very much, Mike. And I will activate Leo again and Mike Hoffman. We're going to get the Q&A started. But thank you very much for the information, and thanks for joining us today. Okay, so we've got the gang almost all, there we go, everyone's on the screen here. So we have a number of questions that we've been receiving. I don't know, Lee, if you wanted to introduce how we're going to start the Q&A as I start to gather some of the questions right now.
Yeah, we'll just
go ahead.
If you have questions, send them in. Michelle, we know we had a couple pre-questions. We'll go through them. Now, the call is scheduled for another 12 minutes. You know, if we have extra questions, we'll stay on, and folks can stay on as long as they like on the Q&A. You know, if we have to go over a couple minutes to get some questions in, that's fine. So Michelle, if you just want to throw them out, we'll try and knock them down.
All right, fantastic. All right, the first one, and I have Post-it notes and my phone and everything, so I'll be looking like this trying to get all the questions organized. The first one is for Mike Hoffman. Planning ideas for bear market. I know we talked about some Roth conversion. As we think about bear market versus bull, does your advice change, or are there any ways we can take advantage other than, you know, you really did cover a lot of that in the beginning?
Yeah, some of the things we focused on are definitely things to take advantage of in a bear market. The same when in a bull market. You should be looking at your risk tolerance and allocation towards the end of a bull market, right? You want to make sure that you're not getting out of line, or let's say you have goals set for buckets of money, right? You know, you may have a long-term bucket right now that's for retirement, and let's say that retirement's 20 years away. Well, we probably don't want to change much there. It's a long-term focused thing. But when you're looking at, let's say you're starting a bucket today that's for something 2 years from now, even if we're in a bear market, you probably still want to have an allocation that's more appropriate for shorter term goals, right? So because of bear and bull markets and the short-term changes you can see, you want to have different buckets for your money to make sure that you're allocating appropriately for the different goals, because there will be bear markets and there will be bull markets, and you don't want to be caught in one of those moments when you actually need those funds, right? So you just want to plan well with the different buckets of money for what it's trying to accomplish. As well, in a bear market, you know, the Roth conversion is the big thing that I like to look at with people, as well as, like I said, the risk tolerance, right? And also, if you have capital on the sidelines during, you know, a bear market, that's a good time to look at that and say, okay, what is this capital for? If it's for long term, we should be getting that, you know, put to work.
Okay, all right, thank you. The next question we have is really it's probably for Leo or for Michael Hoffman. We are an 80-year-old retired couple, depending on Social Security and our IRA for income. Can you speak to any advice that you might have for someone in that position? You know, someone who's living on a fixed income. Any strategies or any helpful tips that you can offer for them?
Yeah, so I think, again, that goes back to risk allocation, right? If you're an 80-year-old retiree, you're dependent on that income, the portfolio, you're going to want to have it more focused towards that, right? So a lot of downside protection, more conservative nature of the portfolio. And, you know, we should have some funds set aside for some of that income needs, right? So that those long-term funds, you know, stocks, for example, they'll have time to recover through a period like this.
Okay, thank you, Michael. Well, one of the attendees asked how and when the world will be free of coronavirus, but I'm not sure how and when will the world be free of the coronavirus influence, either on the economy or otherwise. I know it's hard to project, but just seeing your slides, there was some really good news in at least some of the trends that are happening. Leo, can you take that one? It's just so we can all feel good about the timeline.
Yeah, sure. So the exact date I do not have, but I go back to my rate of change conversation. We have never seen a scientific effort to solve one problem like we are seeing today. And just one other comment on Moderna. For those who are not familiar with what's happening with that vaccine, they had their stage 1 trial, which is limited, but it showed as good of efficacy. It was a safety trial, but it showed efficacy in developing antibodies. They used artificial intelligence. They used artificial intelligence to run those formulas through millions of scenarios to find the ones that wouldn't work before they even started testing. This is the new world we're in. This is the science that we're bringing to the table. And it's causing a much faster outcome than what we're used to. So if we get a vaccine sometime this year or next year out of 100 opportunities, you'll see us very quickly get back from a consumer willing to go out standpoint. A drug will help. But I think more importantly, I think we have to continue to bring this back into context. We're learning more and more about the coronavirus every day, not just that it kills, we know that, but who is vulnerable. And we're getting more accurate models, and that's going to give us the confidence with tracing and testing and a vaccine and therapeutics. I think the rate of change is moving exponentially. It'll be faster than people think. So hang in there. If you're one of the vulnerable, be careful. But I think this will change faster than people expect. It already has. I don't think anybody expected here in mid-May that we'd be this far along. In March, I should say.
Perfect. Thank you. Thanks, Leo. We do have a question for Mike Gill. Tell Mike, go Hall, beat the Dons. not growing up in Baltimore, but I really do understand.
I knew there were some
Someone's
Calvert Hall
jabbing you.
Cardinals watching in.
But we do have a question for you, Mike Gill. Someone was asking, he really was interested in your notion of follow where the puck is going, a la Gretzky. Anything else you can add to that? As far as, I know you've seen so many different flavors of how we're working in this economy and all your different roles that you've had. Can you speak a little bit more to that?
Yeah, I had mentioned, Michelle, about certain industry, all industry sectors. It's a new game. And I think that as we speak, most leadership in those industries, I chair the board at St. Joseph's Medical Center. It's been COVID-19 has been mild at St. Joseph's. Having said that, we're in the middle of strategic planning, and the strategic planning we're doing now is starting to look a lot different than if it were 3 years ago. Looking at all aspects of healthcare. So I think one of the exercises everyone needs to do is just ask yourself, if it's a blank piece of paper, if it's a blank whiteboard, if it's a blank flip chart, and you have your team in the room and you say to yourself, all bets are off, what is it we need to look like to optimize our opportunities going forward? Whether you're a commercial real estate firm, whether you're in property management, whether you're a general contractor and you're looking at the dynamics of the marketplace relative to how technology is going to be used. I think the whole idea of where the puck is going to be is just think about outside the box, talk to others, bring in a consultant if you need to, keep reading. And the beautiful thing is about thinking about where that puck might be is it's really energizing. And it's amazing to me. It takes a heck of a lot less effort. And it's so less stressful to be energized positively than the opposite. So that's what I mean. Whatever business you're in, I'm sure that 15 different industry sectors are represented on this call. And every one of those sectors is going to go through changes and opportunities. And make the call now in terms of what side of it you're going to be on.
Yeah, Michelle, if I could add to that, I'll give you the perspective of our group, not as an investor, but as a business, as Verdence Capital, the business. So, we've really said to our folks here, our teammates, that now is a unique time. I had this conversation with my son, and if anyone was on one of my other webinars, I apologize for the repetitiveness, but I said to my son, who plays football at Wake Forest, who's trying to fight his way through the ranks, I said, God has just reached down and he has stopped the earth from turning. And everything that we expected is now on hold. How are you going to use that time? And so for him, it was, my advice was learn everything you can about the playbook and work out and practice and go back shockingly better than you left. And I think from a business perspective, whether it's Verdence Capital or everybody else, that's what our advice is. It's use the time. Use the time to be better. There's two ways to do this. We can use the time to stare at the news and just bemoan our situation. That's not leadership. Or we can use the time to build. And so what's our building today? Well, we've said to everyone in the firm, whatever that project is to make your area of this business demonstrably better, now's the time. Sit down, do the project, take the time, you have it. We're talking to other firms about joining us. We're talking to partners about joining us. We're actually even talking about starting a new line that's going to not only create a new prospect in our business, but it's going to dramatically increase the service of our clients. This is stuff we can do now because we're sitting here, because I'm not traveling somewhere to have this talk with Mike Gill where the two of us dance around the stage, like we have hot shoes on, but we're sitting in our office at the end of the call. We can get right to it. So take that time and use it effectively. It's a gift.
And maybe to echo quickly what Leo just said, it's an expression I heard many, many years ago. It certainly is appropriate. It's always appropriate, but the expression is, we're only here for a flicker. Think about it. In all of mankind, we're all here for a flicker of it. So the other thing that I would echo with Leo is, if there's something you're extremely passionate about, that you've been passionate about, you just haven't done a lot with it. What are you waiting for? We're only here for a flicker. Get after it, whatever that might be.
Yeah, and I think we're talking to clients a lot about, and prospects about that a lot every day, is saying, take this time to look and say, what is it you want to accomplish, right? What are these goals? Or maybe there's a charity you've always wanted to help, or whatever it may be. You dream it, you come back, and we can help put it together, right? We can build a plan around that. So now's a great time to sit there with yourself or your spouse or your family and say, what are we trying to get out of this, long term?
That's great advice. I did wanted to interject just a comment, and that is we're recording this webinar, and we will be sending a link so that you can watch it later if something's happened, whether there were technical difficulties on your end or maybe even on our end. But we will have the link available for you that will be mailed out to each of the attendees that were both live with us today or have registered to watch it later. So just know that you'll be able to access all of our visuals, all of the comments from our panelists in a link later from the recorded video. So just wanted to make sure I said that, because we're running a little bit, we're right at 12 o'clock now, and I want to make sure we're respecting everyone's time, but I do want to get to some more of these questions if we can add a few more minutes to the webinar. The next question is, what is your view on how state and federal taxes will change over the next 10 years due to the massive losses and stimulus payments, and how will this impact our investing strategy? So that's either for Michael Hoffman or Leo.
Or Mike Gill.
or Mike.
Leo, I've been able to get through an hour by being apolitical. Now I'll have to get political. I'll go very quickly. Common sense, which is not necessarily a trait of many of the elected officials in Annapolis, but common sense would tell you that this is not a time that we increase taxes. Common sense would tell us, as it might have in 08, 09, what other times, that now's the time to, get tighter, get smarter, get rid of stuff that we shouldn't have been investing in anyway, and make sure we have the money to invest in what we should be spending money on. So my concern would be that there are some in Annapolis who are not really in touch with reality, who might really think that the only way we can solve our needs, our current commission needs, other big dollar projects, is by increasing taxes. And I would say the only thing I'll say to you that is not political is, I encourage everybody to do this. I did it for 4 years, and that is, where you live and where you work, go find out who your state senator is, go find out who your representative is in the House of Delegates, and have lunch with them. Call them up, invite them to your business when it's time to bring people back again. Tell them about how you do what you do. I find that we don't do enough of that. And unfortunately, that leaves a big chasm of people thinking that they know what is best for all Marylanders. So that's a little tip. Go find out who your state senator is and your House of Delegate representative and have a conversation.
Yeah, quickly, just from an investment perspective, Michelle, I'll just say this. Speedboats and aircraft carriers. When we look at markets, right, there are speedboat issues and then there are aircraft carrier issues. There are things in the market that turn the markets very quickly, an abrupt pandemic, right, or a earnings call that's horrible for an individual stock and drop a market significantly. The deficit and the massive issue that a deficit, which I don't think anybody would argue, anyone would argue that the deficit is a huge problem that has long-reaching implications for us as a country and for our investments going forward, but it's not a speedboat. If the deficit grows, as a matter of fact, just the opposite, right? The market went up, not down. If the deficit grows, that's not, people get worried about that relative to what it does to the markets now or in a year. That's an aircraft carrier issue. That's going to impact our world over decades. And it doesn't mean you ignore it. One thing about an aircraft carrier, it takes a long time to turn that thing and get it back on to a different track. And we have two choices, right? We can't treat it like a speedboat, it won't matter. We can either speed up on the course we're going, which gets us to the rocks faster, or we can start to turn. And so with taxes, Mike's right. There are things that we can't do in the middle of an urgent moment, whether it's here or another state or as a nation. We have to get through the moment. But what we can't do is keep using moments as excuses to not get that aircraft carrier starting to turn. Let's slow it down. Let's turn it a little bit. There's a lot of ways to do that. That's a different debate. But that's the way we view it.
Okay, thank you. Excellent. Let's see. We have another question. Again, we'll keep going for a little bit longer if that's okay. Mike Gill. The question is, do you have specific advice on growing a private business in a pandemic recession? And I think you've spoken broadly to that, but more specifics of how businesses can take advantage. A lot of things that we talked about in our practice call the other day is just those changes that you can make to really take a look at what you're doing to take advantage of the situation.
Yeah, I'll give you a couple quick thoughts on that one, Michelle. One, I would encourage businesses to do this anyway. You don't need a pandemic for this one. And it's something that I've talked about for years with businesses. In 1984, when I started that company, Americom, one of the first things I did was I created an advisory board, and it was a fabulous group of individuals. It was individuals who cared about me. They cared about our success. They all had their own success. I think some of them actually came to the meetings because I gave them a check for $100. And that always amazed me because they were all really successful people, but I could see them peek into their folder to see if that $100 was there. But they were so valuable. So it shouldn't take a pandemic to think about something like advisory boards. If you don't have one and you're a private business, go get one. If you do have one and it's only on your website and you don't use it, then use it. But I think that what you really need to do at a time like this is get more input from individuals, whether it be peers in your industry, whether it be friends who you have a lot of regard for. I think you got to pick up on your reading so that you can fill your head with ideas. And the other thing I would tell everyone is do the best you can. Try to figure out what is 100% of your capability in terms of being healthy. Because when you're healthy, I said to somebody the other day, there's a part of the brain that releases all the creative ideas, and it's a function of positive attitude and feeling good about yourself. So if you do that, the ideas as to how can I change my business, it'll accelerate. Also, take a look at your starting lineup in your company. Maybe you don't have as many A players if you really are honest with yourself as you thought you did. And you might have to rethink that and encourage some people to, go pursue other opportunities in life. So get an advisory board that you really care about and they care about you and you utilize. Get in the best condition you can because it'll help you work through all the challenges, and surround yourself with people with ideas that you can take advantage of. Quick thoughts.
Yep. No, thank you very much. And Leo, would we like to end it here? I'll leave that in your hands, or perhaps some final comments. I have captured. We didn't get to all of the Q&A today, but I have captured them. So I will try to include that when we release the recording from today's webinar. But I'll hand it over to Leo. Do you have any final thoughts?
Sure. Yeah, I'll wrap it up. And for anybody who does have questions and whose question was not answered, just reach out to us. We'll get you the answer to your question via a phone call or via an email response. We appreciate everybody being on. So I want to thank Mike for joining us. I see your Clemson Tigers picture in the background.
Oh, is that what that is? I was wondering.
Hopefully we'll have a little football in the fall, Mike.
Yeah.
And thanks to Mike Hoffman for his insights, and Michelle, of course, who set all this up, did an amazing job, not only getting us all together, and this is a tough group to get settled, but also handling the call and the questions. But most importantly, thank you to everybody on the call. Thanks to all of our friends and our clients who joined us, Mike's friends and clients. This has been fun. We'd love to continue the conversation. We will be doing more of these. But if you have questions, just reach out. We're happy to discuss in further detail your questions. I'm going to end with Mike's point. Let's count our blessings rather than sit there and, as Mike said yesterday on the call, rather than count sheep, count your blessings at night. I know for me personally, I'm here. The people here are safe. My family is together, which I never thought we'd have them together for this long. A little tougher to shop for all those adults, but it's been a blessing. Count your blessings. Thanks for being with us, and we hope you enjoyed the call.
Thank you. Thank you, Michelle.
Everyone. Thank you so much. Thanks, everyone.